Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
On today's episode, our special guest is Christina Drake. We are in luck today because she has a breadth of LP experience. She has stints at Bridgewater working with sovereign wealth funds. She's been an investment advisor to major nonprofit institutions, and her current role at Renaissance Venture Capital Fund of Funds is just an awesome organization, and they do some great programming too. So we're going to learn a lot today. So with that, I want to welcome Christina to Swim with Allocators.
Thank you. It's great to be here.
You have a very interesting background that not many allocators that we come across have. So we'd love to just hear your story of how you got into this world.
Sure. It was a complete accident, and honestly, something that I probably avoided, I guess. So I studied marketing and organizational communication in college, and I hated my finance classes. And you know that I don't have a traditional background because I say finance. It's not finance. So I hated my finance classes. I hated my accounting classes. I took, the ones that were required and nothing else. Hated the econ classes, all of it. And I figured, I'll go do marketing. And I had a marketing job lined up after I graduated. But I was lucky enough to graduate in 2008. And so the marketing job that I had lined up lasted about 2 months. And then the company that I started with ceased to exist, like so many others, in great financial crisis. And so I totally, I was like pretty blindsided by it, honestly. I felt like I had done all of the right things, and, I had done internships and all of that. And it took a while for me to, figure out what my path was going to be. And I did this terrible door-to-door sales job for about 6 months because no one was hiring. It was a pretty tough time, but it taught me a lot about how to approach people. I certainly wasn't afraid to talk to strangers after that. And eventually I got connected with a recruiter who introduced me to Bridgewater. At the time, I did not know what a hedge fund was. To be totally honest, I'm still not sure I know what a hedge fund is. But it was an entry-level job, and I needed a paycheck. I needed a reliable paycheck. I, figured I'd stay there for 2 or 3 years, get something solid on my resume, and then go do a marketing job. But I got really lucky that I had some fantastic mentors and advocates, and I was able to build a career path there and ended up staying for 7 years.
I also feel like the word of the year for VCs has been storytelling.
Yeah, so true.
Just marketing training.
That's what happens in a down market. Everyone all of a sudden tries to figure out how to be a good storyteller.
And here you are. You already had that skill. Any advice on actually like how VCs can think like better marketers?
I think one of the biggest things, I guess, that I've learned is don't be afraid to storytell. For a long time, especially early in my career, which I think part of this is valid, right? It's like, what do I know? I'm, 23, 24. I haven't been doing this for very long. Why is, what I have to say worth listening to? But over time, you have to figure out how to tell yourself a different story, right? And understand that some of your experiences are worth talking about and might be helpful to others. So that's the first piece. And then the second is probably know your audience and do a bunch of research on your audience and share the genuine and authentic parts of your story that will resonate with them. And then I think the last point for me is speak plainly. I get so annoyed with all of the jargon and acronyms and name dropping, all of those sorts of things. It's like, if you really believe in what you're doing or really believe in your strategy or, whatever it is that you are talking about, you should be able to speak, pretty plainly about it and explain it to someone who's not in it every single day.
Mm-hmm.
Yeah, so it reminds me of my public school teacher mom always saying, if someone can explain something to a 5-year-old, they don't really understand it. Speaking plainly, it shows how much you know about a specific concept or something that's complex because you're able to break it down. So, going back to Bridgewater, because it's kind of like, hedge fund it's a different world than going into the private markets. What are some things that you gleaned from that experience, specifically kind of taking the thread of client services? What did you learn there?
I think one of the biggest things that I learned is the value of market research and insights that might help a client make decisions in other parts of their portfolio. So not just focusing on the narrow sleeve or bucket or whatever it is where my firm's product happened to be living. So for example, there was a point, maybe not too dissimilar from today, when the US dollar was just ripping. And Bridgewater started sharing some of their insights on what was happening, which then prompted a lot of our clients to start to think about what that means for their international exposure, particularly in emerging markets, right, where there can be much bigger swings in the currency exchange. And so they could be getting positive alpha from the core exposure, from the actual strategy, but then the currency drag basically wiped out any positive performance. And so we started doing some custom analysis to help clients estimate how much of their exposure might be worth hedging. And so balancing the trade-off between the potential hedge value and then the cost of actually implementing the hedging instruments. And so it didn't have anything to directly to do with their investment with us. All of their investments with us were US dollar based. But it had everything to do with, what I was talking about before, which is building trust and building a meaningful relationship and, helping to contribute to something that made their life easier, even though it did not have, a direct real-time benefit to us.
Mm-hmm.
So taking that and applying it to venture, does that mean that during an AGM we have more market maps, or should the up and to the right just be, should the line be bolder for you? It's like how should VCs apply this perspective?
I think market comments are always really helpful. The other thing that is really helpful that provides perspective and, in my opinion, also helps to continue to build a relationship and to build trust is being willing to talk about the mistakes that you made, right? Being willing to talk about a miss, being willing to talk about a write-off. And if you do it well, you'll talk about the main lesson or two that you learned from that experience and what you've corrected, right, within your team or your process or whatever it is, to try, to make sure that doesn't happen again. That I think is one of the most meaningful things.
I was just sort of trading notes with a friend who's planning an AGM, and we were sort of saying, okay, which are the things in here that have real value? And our other friend chimed in and she said, most of the market mapping stuff, you start to hear the same thing. That part you can sort of fast forward. But we decided on a phrase, insider insights, as opposed to thought leadership or something where you're a little bit closer to boots on the ground, what's actually happening in these businesses. And so pulling that out so that you can start to have those real life examples of what's happening. I heard from a friend who was like, yeah, I don't know what's going to happen with NVIDIA's stock, but they've made so many senior employees so wealthy that we're all planning on leaving. And that's an insider insight, right?
Right.
That's a fascinating data point that I think more AGMs could focus on some of those sort of I wouldn't call them caveats. They're real tangible data points, but
Mm-hmm.
not the like global market map kind of stuff that everybody's presenting.
Absolutely.
One of the things you discussed was the US dollar. Are there other lessons learned you can share with us from your days working with these big international clients? I think of you probably were dealing with folks around the globe.
A lot of like really interesting experiences, and I learned so much from working with international allocators in particular, especially when it came to sort of comparing and contrasting financial regulations in Europe versus the US, and kind of the like consequences, I guess, of each and how that starts to affect decision making on investment teams. It was just fascinating to watch that play out in real time. Europe has always been a fair bit ahead of the US when it comes to ESG investing. And so I think I was at a real advantage of getting exposure to that several years before it really started to take off here in the US.
And so you got great experience in New York, and then you went off to, I don't know, well, at Bridgewater, and then you moved to a consultant named FEG Investment Advisors. And so could you tell us a little bit about that organization and who they served?
Sure. Yep. FEG began as a traditional consulting firm working with nonprofit institutions, and then eventually also started offering outsourced chief investment officer services, or OCIO,
Yep.
relationships. Where, I mean, I'm sure most of your audience probably already knows this, but in the spirit, right, of explaining things to someone who's not in it every day, consulting is basically, I'm going to give you recommendations on portfolio implementation across all asset classes, and it's for you to take or leave. OCIO, the outsourced version, is you have given me that fiduciary responsibility. And so you provide me with a map, you tell me what your strategic allocation needs to look like and any constraints, and then I'm responsible for actually building the portfolio and making those manager hire fire decisions. So FEG as a firm offers both. My clients were about 50-50, and they were all nonprofit institutions. And so think university endowments and foundations, community foundations, private foundations, healthcare systems, Native American tribes, and then cultural organizations like museums and synagogues and churches and that sort of thing.
What was the level of kind of internal sophistication when it came to the various asset classes, and how much of your role was around not only exposure, but education?
Mm-hmm. A huge part of my role was education. And then I was lucky to work with a great research team that was organized by asset class, to really lean on them to do a lot of the detailed due diligence work. And then it was sort of like having someone. It's like having someone come with you to the Cheesecake Factory. They have like a 1,000-page menu or something.
It's too much.
Like, it's too much. It's like having someone come with you and sitting next to you and say, here are the 20 best things. And then like I could choose from there, like, all right, out of these 20 best things, here are the 5, that I'm going to put in front of my clients. I'm sure that my former teammates at FEG are not going to appreciate that.
I was gonna say, or all the emerging managers being like, okay, so am I in the soft drink section, or am I in the mini pastas?
They're front and center, and I know we'll get to that, but they're front and center.
I give you credit. You put together really pretty photos of the cheesecake. It's been laminated. This is a Bible. So there's a lot of effort that goes into creating the Cheesecake Factory menu.
Right.
I'd love to sort of just dig in on a specific client, maybe a foundation or an endowment that you could just share some color on. I don't know, digging in a little bit on one example.
Sure. I think first, just across the board, all of my clients, and I think institutional investors in general, needed reliable consistent returns, of course.
Mm.
So obviously, like the main thing that we were trying to do is work toward that and to choose the very best managers based on their long-term strategy and any constraints that they had. But most of the time, just as important, clients were looking for really high quality and reliable data. And then they're looking for analysis, they're looking for information that will help them make good decisions. And so, this is, like I mentioned before, this is a lesson that I started to learn at Bridgewater, and then it really became front and center for me when I moved into an advisory role. And so I spent a lot of time figuring out how to like educate and inform clients and committee members on market trends, performance attribution, analysis of past decisions, right? And models for planning out, for example, like how much capital to commit to private markets each year. So these are not super exciting things, but they're pretty crucial to improving your decision making. And the way that I think about it, investing is mostly about trying to predict the future. And so the more reliable and consistent information and data you can have, the better your odds of being successful. So I think one of the most probably impactful things that I provided to clients is what I just referred to, which is literally a plan for how much capital to commit to private markets overall each year. And then like if you drill down by asset class, so venture, buyout, private credit, private real estate, like, drilling down based on what their ultimate strategic allocation target is and the size of the pool of money, taking into consideration any distributions, right? Most private foundations are required to distribute 5% of their capital each year. And then adding in a ton of assumptions about performance and about the path of their existing assets. And then being able to show them and show their committee a really pretty bar chart of like you take all of that together. Here's what we estimate, and it's a guideline, right? Nothing is perfect, but it really helps with planning and figuring out what the next 18 months might look like.
Since you mentioned it, I have to pull this thread. You mentioned like your goal was first and foremost for these foundations and endowments were to provide a plan for consistent returns. In a world where, and I know it was diversified amongst a lot of asset classes, but how has that impacted your view on venture today? When I can't even remember how many unicorns we have in the market today in the U.S. alone. We have, depending on different banks you talk to, we have 50, 100, 200 companies expecting to go public in the next 2 years, whenever that is opened up. And it seems like M&A has kind of really closed down. So how are you all thinking about, as a friend told me, how can you put the narrative of DPI within your story of, whatever you're selling to LPs? How do you all think about that?
I was at an AGM a few weeks ago, and the swag that they were giving away was a Yeti that just said in huge block letters, DPI is the new IRR. Which might be like the nerdiest swag ever, but it's true. Yes, it's front and center. It's something that we have been talking about with our clients for the last 3 years. And so like we actually created our own chart, right, to show our investors how much we've distributed over time versus the market median. And it's something that we look for at every single annual meeting that we go to. So it's top of mind for me right now because I've been to 4 of them, I think, in the last 4 weeks. But we're looking for details on exit planning, and that, of course, was a consideration, right? When we would meet with managers, either managers that are already in our portfolio or new ones that we're diligencing and considering putting in our portfolio. But it has become like the main area of focus now. So yes, I want to hear about what you're doing to help your portfolio companies grow and scale and hit ARR milestones. But I also want to know, like, how are you staffed and how are you structured, and what processes do you have in place, and what relationships are you building to help work toward exits. And some of the funds that I've seen do this really well, they actually have a plan for every single portfolio company.
Oh, wow.
And they've mapped out, like, here are the types of relationships that we need, whether it's private equity or whether it's a corporate strategic, or whether it's an investment banker, to eventually work toward an IPO. They've mapped it out, and that is what I would love to see from every manager. I know, particularly at earlier stages, seed and A, that might seem like a ridiculous request. I'm fully aware of that. But you have to show, right, that it's on your radar.
Yeah.
At the very least.
Now we're going to take a quick break to speak with our sponsor.
On the show today, we have a friend and industry expert, Nick Talwar, fractional CTO for both VCs and their portcos. His agency, Bottega 8, trains custom AI models for financial institutions like yours. Welcome, Nick. Your firm, Bottega 8, offers custom AI model training for financial institutions like PE, VC funds, investment banks, and fintechs. Why do you need a custom AI model training versus something off the shelf?
It's a great question. Yeah, there's two big advantages to custom AI model training that we bring to the fore. One is, like, we're seasoned experts. Pretty much everyone on our team has like 10 plus years of machine learning, data science, AI. And second, we have exclusive access to NVIDIA GPUs right here in the US. So the same ones big tech is hoarding, we got them through a series of partnerships, which is great. And that gives you big edge without the overhead. And big tech wants you to use their APIs in the cloud, and there's a lot of challenges there. First of all, LLMs are very generalized. They're powerful but tricky. They're like extremely horizontal. And you need a lot of engineering gymnastics to fix issues like hallucinations, injecting the right enterprise data. Like, you have to hire an AI ops, AI engineer, backend, data scientists, and they're all highly sought after right now. And you gotta, we've already iterated through multiple technical architecture formats to, use these big tech APIs. When the real solution a lot of times is just train your own model, but it's kind of esoteric and elusive, and none of the big tech marketing is going to tell you that, obviously. So the custom model benefits, you can skip those constant updates and shifting and all that complexity. You don't have to hire an entire engineering team, and then you just have a core model that has the context of all your proprietary data, building a moat around it, and then a lot of times actually improving your IP story, because we all know how fractured data can be in all these different silos in an enterprise. But if you train an LLM along it, or fine tune and off the shelf, we do both, you'll basically get like a smart version that's assessed all that information and made sense of it. You can just chat with it and deploy it yourself. And, then it's just like very easy. It's just as simple as an OpenAI API integration, which you can do in like 30 minutes, but instead it's an entire model that has the context of your entire organization, private, secure, and preserves your proprietary moat. And you just have lower costs and more control this way. And then so the final outcome is a competitive edge and more control over your IP, and it's practical and efficient. We just focused over the last year and a half around what is that true barrier to getting towards this amazing secret sauce that we can do as engineers, and that's literally this. And so we're bringing it to the marketplace.
And what does this end up looking like for financial institutions? I'm curious sort of what the end product, how that goes into play for them in their businesses.
In a lot of different ways. Like, if they're cybersecurity and privacy, like if you're a family office and that's really, really important to you, you might have generational data. It's then we'll air gap it, and we'll even deploy it on-prem. And so you'd have that in your own infrastructure. Like this is also great for hedge funds, et cetera, that we've been speaking with, that, that's their competitive edge. And so you do it that way. Another way is like we'll deploy it and do some simple servicing. It's really easy. And then maybe once a quarter, help you retrain it if you want. And to most of these customers, it'll just look like you're talking to ChatGPT in a lot of ways. And they can also use it along with ChatGPT. So that's even more interesting. It's very easy as to like, you basically have your core proprietary model, and then that has all your data. And then you use ChatGPT or these generalized models for sort of general questions. So, how we're all familiar with using it, but in more of an enterprise context. And then you can basically have that at your disposal and don't have to rifle through all this data or pass emails and stuff like that.
Sounds like sounds like privacy is sort of going to be a key element here.
Yeah.
What are sort of some of these security risks that are inherent with big tech AI APIs versus building something custom?
Yeah, these risks can lead to significant reputational and financial costs. So I'm glad you brought that up. So with big tech, AI, there's data aggregation and profiling risks. They update, data across multiple, like tens of thousands of customers, and that means sensitive data points. And then they can use fuzzy matching and these to actually like stitch those together. And over time, in the IT world, we call that like sort of leakage by unintentional egress and fuzzy matching. Like that can be done to stitch things together. Like ad networks have this problem all the time. Secondly, anonymizing data is very, very hard. And even if you do so and do the integration, and big tech claims that, we're gonna give you your own private sandbox, systems trained on the entire internet are getting so smart they can re-identify. Yeah. And as much as we think that we are like the most like unique flower in the entire garden, there is content on the internet that can reconcile and bridge that gap. Mm-hmm. And then there's limited control over data use. Once data is ingested to a big tech system, really hard to monitor who can access it. There have been data breaches, like OpenAI had multiple of them. Yeah. And this is really important. Like, for financial firms, their institutional brand is decades old. And so whether you're a hedge fund, PVC, family office, and you really can't, muck around with this stuff, especially when it's shifting so fast. Mm-hmm. And so, and at the end of the day, big tech can be just a black box, and it's better to just, do what you can on your own and control that.
You hinted at this a little bit with your NVIDIA partnership, but building custom AI models sounds expensive. How do you make it more affordable?
Yeah, we have in-house expertise, so you don't have to hire an engineering firm or engineering team. And we have like a streamlined end-to-end process. And frankly, a lot of times, like if you don't even have an engineering team, much less an IT team. So where do you even start? Like a lot of times with our clients, they're just like, we don't even know where to begin. And so that is expensive. Spinning is expensive for a quarter, trying to figure out like what to do if you were to embark on this on your own. And we have direct hardware access that very few other folks have. We have minimal ongoing costs. We can just basically help you. Once it's trained and deployed, we can help you. And then we offer a lot of on-prem access for security reasons. And we can do it how you wish, and ensure that like things are air gapped and you have that peace of mind. And so that's how we operate. And we think that it's like probably 80 to 85% more cost effective to do it this way.
No, having that specific focus on financial institutions, I feel like you've ironed out the process so that it's something that you can implement for other new clients. Well, thanks.
Yeah, we do our best, and obviously it's an evolving space, and we're learning and changing every time. And the concept of an AI expert today is almost like an oxymoron. Like you're learning every single day something else is coming through, but we know in the last year or two doing this, lots of projects that this service kind of solidified as a deep need for financial institutions. So
A
we're
very
rolling ahead
humble.
with it.
You're far more of an expert than most of us.
Yeah, maybe a little bit more than some, but not all.
Thank you so much, Nick. If you are looking for help implementing AI at your fund or across your portfolio, you can please go to bottega8.com/swimming. That's BOTTEGA 8 as in the number .com/swimming. We appreciate you giving us the credit, so please use the URL. And now back to our LP interview. Can you give us just a quick 411 on what is Renaissance, where you are now?
Sure. So Renaissance Venture Capital is a venture fund of funds based here in Michigan. We aim to invest in the best lower middle market venture funds across the country. And then we use that network to bring funds to Michigan and to introduce those VCs to Michigan founders with the goal of eventually getting more deals done in the States. And then the third thing that we do is we connect Michigan-based corporations with our underlying portfolios. So startups that have been backed by the funds that we've committed to, and who are doing things that are interesting to those corporations.
And so, are your LPs primarily those corporations?
Our LPs are those corporations, yes, and then they're also endowments, foundations, pension funds, family offices, a handful of high net worth. But Renaissance was founded in 2008, and we had our entire LP base were those corporations. Mm-hmm. So they sort of banded together behind the premise of Renaissance, which I feel like I always feel like I have to give this disclosure. We are not an economic development fund. We are not an impact fund. The way that I describe it is we are a venture fund with a really smart, thoughtful, kind founder who just decided from the very start that he wanted to use his network and use the network of being a fund of fund to help solve some of the innovation gaps in his own community.
For the GPs listening, why should they be coming to Michigan? Tell us about what's in Michigan.
Well, I can actually answer that for you. I was going to say that I've been able to witness the intentionality of Renaissance in person. I actually, what was that, a month ago? Or I can't even keep up with everything.
Oh my gosh, it feels like it was 2 years ago, but yes, it was
a month ago.
3 weeks ago.
3 weeks, yeah. Went to Renaissance's Undemo Day and got to go to Ford Field and meet with a lot of startups and also ecosystem innovation stakeholders in Michigan. And I love what you all have built. The turnout was amazing. There were investors from all over the country. And I just wanted to say, kind of, how did you all come to this approach? Because when I see so many, I'll pick on my home state, so many fund of funds in like Arkansas, the approach is there has to be a mandate of like, hey, you have to invest in here. And you guys are taking the kind of the long-term approach of influencing the ecosystem. Mm-hmm. Kind of talk to me on why and kind of the things you've learned on taking that approach.
Sure. Well, first, I cannot take any credit for this. I've been with Renaissance for about 2 years. And so the team has built these things and has built a reputation and an infrastructure that I'm biased at this point now, but it's so nice to hear you say to live up to like all of these great things and to be really influential in the community. Undemo Day started, and for the audience, Undemo Day is essentially at its core, it's really, really highly customized speed dating between Michigan founders and investors from all around the country. And Undemo Day began about 10 years ago. We were inviting all of our LPs, but also all of the funds in our portfolio to come into Detroit for our annual meeting. And Chris and Jeff and the team had the thought, well, since we have all of these investors here, why don't we ask them to stick around for another hour or two and introduce them to some startups from the state? And so the first on demo day had like 8 or 10 startups that we introduced to the VCs who had traveled in. And 3 weeks ago, the event that Ernest, you were just talking about, we had over 240 startups apply to participate and had over 600 attendees for on demo day. And part of, I think, why it has been successful is because Michigan has like really fantastic momentum for the entrepreneurial ecosystem, and there are great ideas and great startups that are coming out of the state. The other thing is, I think people, especially with COVID, silver lining, I guess, have started to realize that they can pretty much live anywhere they want and do the job that they want. And Michigan is a fantastic place to live and to build. And then the third piece is that, investors, right, have seen that it's worth coming and spending some time. I don't think that this is particular to Michigan, but I think it's more of a Midwest phenomenon. Valuations tend to be a little bit more reasonable. Exit expectations tend to be a little bit more reasonable. I've lived and visited lots of different parts of the country, and so I feel like I can also say people are pretty, pretty easy for the most part to work with. And so I think all of those things have combined, and you layer on that just consistency, right, of people continuing to show up and continuing to sort of show value to all of the groups involved.
Yeah, it was an amazing event, and I thank you for inviting me. And I think more, you know, approaches should be applied like that in the country. I know there's one, I forgot the name of it, but in Ohio, there's one that's happening in Milwaukee now as well. That Grady runs, kind of a similar kind of model. And
And
so,
D&G, yeah.
yeah, yeah. And
They're
so I
great
think,
friends.
yeah, so I think we should have more of those, and then we'll start to see these hubs grow more and more, and then also the connectivity, because I think as automation grows, all these industry leaders in different industries all over the country, they're going to have to embrace technology and also have clear partners and ties and have that trust built. Yeah.
I think that's right. Ernest, I think the one other thing I wanted to say, I don't know that I got like to the core of your question before. So yeah. I want to just make sure I add, you asked, why not require, right? The funds that we invest in to do something in Michigan. And I think it sort of speaks to kind of the culture here in Michigan, and in particular in Southeast Michigan, just where Detroit and Ann Arbor are, which is like a little bit of a chip on your shoulder, like really hardworking, a lot of grit. And I think the short answer to your question is we wanted to prove that we could meet our goals without adding those requirements. And I think that we have. I mean, we have attracted $3 billion of venture funding to entrepreneurs based here in the state.
Wow.
Without putting any, constraints or obligations on the investors that we work with. And so it was it's like one of those, like, it's here. And it was one of those things where it's like, we're pretty confident that if we bring you here, if we get you here, right, that you'll see it. And eventually we'll create some movement, and we'll create some momentum toward those goals.
And you're sitting on the investment committee. For the managers who are listening, who's a good fit for your fund of funds? Who should be pitching you?
Sure. So we start with fund sizes that are about 75 million. I think our sweet spot is between 75 and probably 350 or so.
Okay. And
we look for specialists. So specialist investors, high ownership, high conviction. From a sector perspective, we, as as a Renaissance fund, we're trying to be broadly representative of venture. We're not taking any sector bets. And so it ends up being about 50% tech, about 30% healthcare. And then the balance is in more emerging sectors. I would put manufacturing, materials, mobility, emerging for venture, right?
Yeah.
Ag tech, I would put in there also. From a stage perspective, that is where we have a bias and we shade to the earlier stages. So most of the funds that we invest in are seed, they focus on seed and A. And all of this is codified in a 6-tenet framework that we created to guide our diligence and guide our decision making. There's over 3,000 venture funds in the US.
Yes.
And at Renaissance, we commit to anywhere from 10 to 15 per fund.
Yeah.
So we have to be really intentional and really specific about what we're looking for and about what we think will, set us and set our investors up for success in the long term. So those tenets are strategy, differentiation, performance, of course, like track record, sort of a non-starter, alignment, risk management, and culture, which is just a fancy way of saying we have a no jerks policy. And then, sort of what I referenced before, one of the things that, I would put this under probably strategy and differentiation. One of the things that really stands out to us now and that we're always looking for is a focus on exit funding.
I love that.
We hear more about risk. It's one thing that LPs haven't spoken too much on the show.
Yeah, it's sort of counterintuitive for venture, right? But the way that we think about it is is your house in order? So do you have a recognizable auditor, law firm? Who's your admin? Those sorts of things. So just making sure that all of that's in order. Insurance policies, so things that often are on page like 142 of the DDQ.
You've blessed us with so much kind of information today and insights, and thanks for sharing your story. Is there any final thoughts that you have for our audience of LPs and GPs that, kind of parting thoughts?
Detroit is the place to be. Yeah. There are so many things happening here from a startup perspective, from, just in general, a venture perspective. I really want to make sure I give a handful of people a shout out. So there was a report that was released last year that named Detroit the second fastest growing geography for venture in the whole world, behind Dubai. So like, if you didn't, if you needed more proof, I mean, there's that study. The startup scene here in Michigan is just really exciting. There's a lot of positive energy and momentum across the state, and there are dollars that are flowing from the state and from funds within the state. Just to give you a flavor, you have like Sharif with the Hyperfiber team, which is an advanced manufacturing startup that creates steel fibers to reinforce concrete structures like bridges. You have a biotech startup called Circnova, which is led by Crystal Brown. She just closed a $2 million round. You have AI-enabled fintech for millennials called Pocket Nest. You have Tread Cycle, which is an end product manufacturing startup that is using water jet technology to break down old tires into reusable rubber material.
Oh, wow.
You have First Ignite. They're an AI software for the commercialization of research. So it's just it's all sectors everywhere, and there's a lot of great things happening here. A lot of these organizations are also on the Renaissance Michigan Startup Hot List, which is on our website. Other great resources, if you want to get a sense for what's happening in the state, are Michigan Founders Fund and Black Tech Saturdays, run by Alexa and Johnny Turnage. There's just so much momentum here, and everyone should come check it out.
Thank you for that. And I agree. Everyone should, every investor, GP, every allocator should check out the Undemo Day to get a glimpse, see it for themselves. And Christina, I just want to thank you for making time for the podcast today.
Ernest, Alexa, this has been such a pleasure. It's been a lot of fun. Thank you so much for having me.
See you later, allocator.
After Portfolio Tile, Investing with a Smile.